Okay, a very good afternoon to all of you for our monthly market update September. So our theme or our template is more of same that we normally say every month. We will start with global economy, then we start with US economy. We'll discuss Indian economy, Indian equity market, other asset class, and we'll close accordingly. So we normally kept the template same so that it will give you a flow about what we have said last month also and this month also, and it will not be an isolation. So you can see actually the trends the data is showing of your own and decide very prudently about your investment and what's happened in the economy. Not only like we giving our own opinion, so you can judge from your own by seeing the data itself. Okay, so we'll move on with the global economy. So what is happening in the globe right now as far as the economic things are concerned? Globalization to deglobalization, protectionism is coming up slowly. There is an ample liquidity to tight liquidity right now. You will see the data in US, how they are struggling with their debts. Zero low interest rate to declining but elevated interest rate. Okay. And we have economic and social concern. Unipolar to multipolar world we are moving around, and disruption, that speed and scales that is happening. Okay. So now most commodities are down 20% or more from their 15 weeks high. So if you see gold, if you see copper as an instrument, if you see cotton, natural gas, like most of those commodities are what they are 52 weeks a year back, they are down approximately 50%, 20% average if we take into consideration all. Okay. Inflation is also showing sign of easing. So this data I normally show every month. So if you can see the graph itself, this is also showing, I have mentioned the different economics so that you can get an as data out what exactly is happening. Even when you see the India data, the Indian inflation number has also come down recently. Global rate cuts are underway, Fed likely to follow. So this is the rate cuts. This is increase, this is no change, this is decrease. So if you see this duration, 22-23, there is one rate increase happen. Now in this 23-24, you have seen the rate cuts are happening. The US has yet to done that, but they will gradually be follow soon, probably after their year's elections happening. So we have seen that most of the countries are into the rate cut phenomena. Okay. So bearing Japan. So Japan is the only country recently in a much where they have increased interest rate, as well as Russia has also increased interest rate. But they work in a different pattern, so we are not going to discuss that today. But if you see the data, the most of the countries are actually decreasing their interest rate. They're cutting interest rate. Lower rates will bring respite in serving higher debts. So obviously, if the interest rate reduces, this will help to serve the higher debt and the costing will be less. China has diversified its trade, becoming less US dependent. So this is an important data point. We have been seeing that how China is actually spreading its own resources, export to different countries in different zones, and they're getting less dependent on US because that is the strategically they think. So if you see the data, share of Chinese export going to be selected. See the North America, this has been declining. Okay, so America, they were declining. If you see this Africa, Latin America, and Oceania, their share is increasing. So China, what they have intentionally done is that they're getting less dependent on US for their export and other countries. This is a very interesting data point which I have showed to you. China continue to see economic headwinds. China has seen some improvement in data. I have mentioned in last 2 months that China is struggling with their economy, but off late they have seen a slightly movement. You will see the service PMI, it has slightly moved upwards, as well as the marketing exporters are also picked up a little bit. They have been down, I have told you, in the last 2 months, but they have been down, slightly improved in this August month, in June, July, August month. China is facing some headwinds. Youth unemployment is greater than 17%. So if you see the data, China urban youth unemployment rate, China urban youth unemployment rate excluding students. So this is some kind of concern for them. Okay. Reforms to fuel 8% growth globally. This is an Indian data point. Well, I will not touch base on more on this thing. So what's happening in the globally is that US recession, you will see the data of yours when I will show you the US data. Israel-Iran conflict is happening in the Middle East. We all know unwinding of the yen carry trade. So that's what exactly happened in Japan. I told you I will not discuss about the why Japan has increased interest rate because that then will take a longer time. But this is because of that. China slowdown. I have already told you. Off late, last month they have shown a slight improvement, but that's not a trend. You see, the unemployment is increasing out there. They have been slowing down in the couple of other sectors. Uh, Bangladesh crisis, yes, that's a big thing which is happening in the globe because Bangladesh export is huge and basically into the garment industry. And so these are the some of the risks which are there in the global economy. Now, what are happening in the global economy? Very interesting data. We all know that when the stock market falls, the gold, rises up and vice versa. But what is happening? Like stocks are falling, like the big tech bubble has popped. Now, this is I'm talking in the specific of the global market, not Indian market. Don't mix up with that thing. Oil prices are falling like we are entering into a recession. Gold prices are falling like rate cuts got cancelled. Bond prices are falling like inflation in a rise. Natural gas prices are falling like there is no demand. So bond prices are falling like inflation is a rise, but actually happening reverse. Okay, inflation is actually reducing, but bond price is also falling. So strange phenomena is happening. Crypto is falling like risk appetite has disappeared. So natural gas prices are falling like there is no demand. So exactly that is the thing which is happening in the globe. Now, we talk about the global economy. So, in a summary, what we are going to tell you is that in a global economy, we are seeing China is getting less dependent on the US as far as the export is concerned. And China's economy is still rallying behind degrowth, what we have seen in the last couple of months. Okay, but they have seen a slight improvement in July, August month. China's unemployment is also increasing. We are seeing the inflation around the world is decreasing. We have seen the rate cuts around the world are happening, bearing one or two countries. And most of the global economies, like if you talk about the oil price, if you talk about the stock, if you talk about the crypto, if you saw the bond, all are falling across. Okay, so that's happening in the global economy as such. Now we talk about the US economy right away. Now, Fed is maintaining a very delicate balance between growth and inflation. This data I normally show you every month. So if you're consistent in my monthly market update, you will see this data happening. So that's rate hikes since last month, 1983, and all those things. So so US has been a long, long time. They have not increased or decreased their rates. Decrease their rates. US economic growth led by high level of deficit. So federal surplus or deficit as a percentage of gross domestic product. So if you see the US recent to growth, whatever they have happened, that has been led by a high level of deficit. So they have been pumping a lot of money into their economy, and as such, their debts are huge right now. So if you see US debts, that's what I'm talking about. US national debt surpasses 35 trillion. Debt per citizen is $1,04,000. Debt per taxpayer is $2,68,000. So that's what happening. So US federal debt to GDP ratio is 123.21%. In 1960, it was 52.46%. So imagine how much debts that US are into right now. US interest payment may hit an all-time high 1.2 trillion even in 200 basis point rate cut. So this is the one of the reason I've told you the US have not reduced their interest rate, but they probably will do. Probably they have an election coming up in October, November, so probably you will see the rate cuts happening there. Although they will rate cuts, but highly it's unlikely that their interest payment will go down because I have already told you US is having a huge debt pressure on them. US job growth moderate, largest cut since 2009. So if you see the US job cut growth, it is in a negative frame right now. US appears to be a soft and bumpy ride. US PMI is showing sign of mild contraction. Manufacturing service relatively stable. So if you see the US manufacturing, this is the manufacturing data. It is going down. Service also is going down, but is some kind of holding up to your normal level. Lack of optimism is visible in the sentiment in the industry. So this is what exactly is happening in the US. The lack of optimism, they are having a bumpy ride as far as the manufacturing is concerned. So that's what happening in US. So to give you a summary, in US, what's happening is that they are having a huge debts. As a result, they are having to pay a huge amount of interest payment, which is affecting their government balance sheet. And they are manufacturing. They are, although the service is somehow stagnant out there, it has gone down, but somehow on average level, the manufacturing PMI is coming down. Their unemployment rate has increased over the years. Okay, so that's what happening in US. And we are expecting that they can reduce, they have to reduce the interest rate. Just we are waiting for that thing. So one interesting thing that if US cut interest rate, most of the money which has been lying there, okay, they will make route for coming to the new market in a developing market. And which country they will come apart from India? So if you see the data across, you will be able to find out why India is a lucrative opportunity for FIIs also. So now let's talk about the Indian economy. India is a oasis in the desert. So Moody's rating upgrade India GDP growth forecast from 7.2% in 2024 and plus 6.6% in 2025. So 6.6% से वो लोग 7.2% GDP फोकस इंक्रीज किया है मूडीज ने. Net direct tax collections grows 22%. GST collection has been more or less stagnant at 1.7 trillion. So that's what we have seen, a 10% year-on-year growth. India's CPI inflation, what I'm talking about, India's CPI inflation has eased to 3.5% in July from 5.8%. So inflation reducing is a very good thing. Okay. So when you have the inflation reducing, India, although has not cut the interest rate, but they will probably waiting for the US to do that. So once they will do, India will cut interest rate and they will have a huge impact in the stock market as such. So people are saying that stock Sensex for 84,000, it's an all-time high and this thing. But we are seeing, when you see the data, you will be able to understand why we are not very bothered about that. Although valuation are stiff, but with this number, the inflation coming down, you can see a big pump up in the equity market also. See, when the inflation number goes down, the interest rate will obviously goes down. If the interest rate goes down, the companies which are mostly work on debt equity ratio and a higher debt side, their expenses will also come down because the interest expenses will also come down, and that will affect their balance sheet also. So this data is good. As far as the GDP focus increasing, India's GDP growth, direct tax collection increasing, GST collection is steady at 1.75. So we are seeing a very positive aspect in India. I show you the data in US, I show you the data in globally. Vis-a-vis, if you see this data, this looks very, very promising. India tops emerging market tracker. So again, this is a Bloomberg data collection. So Bloomberg is a global data agency. So this is not from India. So this is, people might say that Indian government is saying this data, but this data is from Bloomberg. Okay. So if you see this data composite score, you see that India's GDP real growth, this PMI manufacturing across all segment bearing one or two, you will find India is topping the chart. And that's why the composite overall index for the July end is 81. It is way above that any other country on the emerging market side. Now, why this thing has happened? Now, people are talking about why this thing. Now, this is the important data. You can take note of that. Now, we have categorically shown you the data from FY 2014 and FY 2024. If you see the freight rate, rail speed, earlier in 2014, it was 25.9 kilometer per hour. Now the speed has increased to 37.8. If you see the road construction per day, which was 11.7 kilometer, now it is 33.8. If you see the power generation, every sector in the last 10 years, we have increased in manifold. If you see the airport capacity utilization, it was 85% in 2024, and now it is 114%. So that is a result why we are talking about the GDP growth and numbers are happening because of this particular slides. If you see the infrastructure efficiency, which has improved over the last 10 years. India's share of world export rising, especially for the service. If you see the world export goods export share, this, and world service export share. So if you see in December 2012 to right now that time we are around 1.5, 1.55%, and now it has moved up to 5% level. So that is the kind of Indian export share has rise in the service sector. In goods sector, which was earlier we used to have 1.6, and now it has moved to 4.9% approximately. So this is the kind of growth which is seen, especially in the service sector. India's export has growth. Rising capacity utilization level indicates operating leverage. Tractor. Now, this is another important data sales, like tractor sales growth back in positive territory. Now, I have been telling people from the very long, like that the only number of factors, only important factors which I normally take that where is the economy is going is the tractor sales. Now, a lot of people might be questioning why. The commercial vehicle sales and the tractor sales, these are the two main indicators of how the economy is performing. If the tractor sales is growing, then you might know that the rural economy is going. And if the commercial vehicle sales stops, then you will understand the economic activity is going. So you don't need to have a rocket science and economics to understand how the economy is going. Just see how the tractor sales over the years has moved up and how the commercial vehicle sales has grown up over the years. So this data actually tells you that from June 2022 to June 2024, if you see the number production of tractors and sales, so this numbers has actually gone, it was below and now it has gone up. Both the number as was below has gone up. So that's why it is 8.1%. Production has increased and tractor sales has increased 1.4%. So although it is negligible, but still it has a big impact. Kharif crop acreage sees increase. So this is the kind of, I have mentioned different vegetables, uh, different crops, how their productions has impact over the years from last 2023 to 2024. Now, rural employment gradually diversifying beyond agriculture. Now, in June 2019, we have seen that there are 51% people are in rural are dependent on agriculture, whereas it has gone down in June 2024, like in 5 years, it's 50%. So nearly 1.5% one is the impact which has happened. You might see the 1.5%, but it's a big impact. Now, this 1.5% rural dependency has been gradually shift towards services and industry part. So if you see this data point, which was actually services, which was in 24% in June 2019, it has moved up to 27.2%. Okay, 24% say 27%. That's a 3% jump approximately. And if you see the industry, it is 24%. It has also gone down a little bit, and as well as the agriculture. So service has actually impacted rural employment as far the data is showing up. GST collection. This is the GST collection over the years. I have shown you earlier. We used to have 1.6 approximately. Now it has GST collection has improved 1.75 lakh crore every month that we are getting. So that's huge numbers. Rainfall this year is 5%, is 4% plus. If you see this 4% last year actuals, and this is the normal. So we have a little bit higher rainfall this time, but this is absolutely normal. Now, this is the water reservoir level average everywhere across India. It is, you see this number. This is the average of 10 years. This is the last year, and this is the current year. So current year, reservoir is higher, but in north side we have a little bit of water deficit. But otherwise, if you see across India, so we are better off than last 2-3 years or that last 10 years average. Oil prices fallen 9% since August 2023. Capex decelerated as contract awards and new tenders soften. Investment to rise. Infrastructure investment, if you see the data from 2001 to 2024, what we are right now, from here to here, we are increasing infrastructure investment as a percentage of GDP, and it has been forecasted that we will continue to increase from here. So government also focus, government all tender and everything is also focused to the infrastructure investment. Investment to rise to peak of 36.2% GDP by 2029. So if you see this, 28, 29 data, so we are able to see a rise of the infrastructure level. This is the time when actually is the COVID period happens. Okay. So India is among the critical tech leader behind only US and China in AI. climbing the research pyramid. So if you see the US and China, and then you see India. So India is actually climbing on the tech also as far as the AI is concerned. India's GDP growth slows in Q1 20 last quarter. So we have seen a little bit slump in the GDP, but predominantly we expect this thing to recover up in next couple of quarters. Economic activity remained flat in July. I just quickly move on for the slides. Manufacturing PMI output index a 7-month low. So this data in the last July, August, we have seen a little bit shrink in the manufacturing. So I just want to show you how we are performing. So from July, from 2015 to 2024, if you see the stretchable number, we have improved in overall manufacturing output, employment, and stock and purchase. Okay, so every month and so it will have some ups and downs, but if you see in a longer stretch, it has moved up. Okay, this is the data point where we have the COVID situations. Now, high stock, low demand drive domestic car sales down. So if you see the car sales happening, this is the Maruti Suzuki, Hyundai, Tata Motors, Kirloskar, and you see only the rural two-wheeler seller has gone up. Rest has gone down apart from Toyota, Kirloskar. Asset quality in microfinance portfolio declined. This is another data point. Interesting data point. Those who are looking for fixed deposit or corporate bond investments in those kind of companies, normally microfinance companies and all. So if you see the data out here, Q1 2024, and then we have the Q4 approaching. So data point says that 30 plus delinquency, if you see it is slightly increasing and expected to increase. So that is the reason why I'm talking about that a little bit of cautious and look for the good quality papers if you're investing in corporate bonds and other paper. Okay. So that's what about Indian equity market. To summarize Indian equity market, we have seen nothing new every month. I've been telling this thing. We have a sustained GST flow, GDP growth forecast, although slightly reduced from the last quarter, but Moody has expected it to be 7.2% in next, in this financial year. And we have, higher direct tax collection coming up. Rainfall is absolutely normal, 4% higher. In fact, we have tractor sales improving. And although the manufacturing PMI and the service PMI has declined slightly in last quarter, but if you see the number over a period of 10 years, we have grown much higher. And if you see the last 10-year data point, in terms of port capacity, in terms of airport capacity, railway, road infrastructure, everything has moved higher up. Okay, so that's what India is all about. So comparing to global market, comparing to US market, India looked absolutely great. So let's focus on the Indian equity market and what needs to be done. Profit are likely to approach 6% of GDP by 26 PE. Market cap and PAT both are on up. So this is the data point. Okay, a lot of people are saying that why stock market is going at 84,000 and it is reaching new high. So if the market cap is increasing, the profit after tax is also increasing. So if this was the lower side is not increasing, then it was the cause of concern. But since the profit is increasing, you will not find the EPS to be much on a higher elevated side. Market capitalization GDP obviously is an all-time high because although we have seen the market cap and profit are increasing, if you see the last slide, so this has been a quite steep out there. Okay, so market capital and GDP at all-time high. So this actually tells us that the overall market valuation in India is costly. Okay, so this actually, so normal average is around 84, 85, but you will soon find this average probably next year is going high to 90, 95 level. So because of, see the last consistent 3-4 years, we have been seeing the market cap to GDP's normal average. So this average has been taken from 2006 till date. So because of the lower base in earlier year, this average is down. So if I take the average of last 5 years, then the average will not be 84. Then the average will be somewhere around 100, 105 kind of thing. Okay. So this is a data point that has to be taken in the context kind of thing. India's contribution to the global market cap at an all-time high. So if you see the global market cap, earlier average was 2.7%. Now it was 4.6%. Again, I'm talking about if you see the last 4 years average will be much higher in that sense. valuation at premium and historical average. So that's what is important. I told you about the Nifty. There's a large cap where you have a 14% premium. The small cap, you see the premium is 42% and the mid cap is 31%. Now, interesting data point last month, if you remember, if I told you, large cap was at premium at 6 to 7% and small cap was at 35%. Now, it has increased high. So, a lot of money are coming into the equity market as such. And despite small cap having a huge premium right now, people are keep investing in the small cap because they have seen the past return kind of thing. This is the Nifty composition, okay, reflecting the valuation. So if you see that Nifty private, and this is a private ownership, this is a government ownership out of the Nifty company. This is the global ownership, this is the domestic. You see the data point out here. The domestic ownership has increased. Okay, earlier this is a global ownership. If you see the government ownership has decreased, the private ownership has increased. If you see business to consumer is increasing. So this data actually tells us that a lot of retail participation is actually happening in the Nifty. Large cap, market cap high, but previous peak. So I just quickly move on with the slides. Okay, market cap contribution and median small at all-time high. I've already told you the data. Domestic ownership has increasing. So this is a data point. I told you that domestic ownership is increasing, like the FII ownership in the stock, overall stock in the Indian market are decreasing. FII has turned into a marginal buyer in India. So this is the data, like over the period of time in August, FII start becoming a marginal buyer. Now, this data you will see once the US election happens, the rate cuts happening, this data will actually be reversed. A lot of US companies, US buyers will, FII will come to India. And that's why you can see a huge pump up in the market also in that time. Dollar weakening is emerging market positive. PE expansion, earning growth. So this is the earnings in large cap and this is the implied PE. Now here the difference, the problem is, the earnings and you see the PE. PSE rally is liquidity driven and this is the NSE performance in November 2023. Indian companies versus global peers, see the expensive valuation. Now, this data I have seen a little bit of different this time. If you see the Blue Star versus Daikin, Blue Star market cap was 3.9 billion, where Daikin is 40.6. If you see his PE, Blue Star P 76, where it is 22. Revenue, you see the difference. Like despite having the price is much on a higher side, if you see the valuations perspective are Indian company, you will find much higher. See the P ratio. This actually tells you, although they are having PAT is such a low with Daikin, PAT is much higher than Blue Star in comparison. You will see the P ratio to be much higher side. Similarly, I've given an example of HUL. If you see the defense sector, Hindustan Aeronautics Limited versus other companies in the globe, if you see the P there, you see the price earning ratio, other companies are much lower. Okay, and because of, you see the revenue out here, PAT also, profit after tax, also an order book, what I mentioned to talk about, and compared to the market capitalization. So that is an interesting data point about Indian companies versus global peers as far as the valuation are concerned. So obviously the Indian company valuation are much higher, stiffer as far as the overall books are concerned. Earnings growth and upgrades are slowing. Now, this is important data point. BSE top 500 companies, if you see the top line growth, this is the top line sales, which has been slightly decreasing. Profit is also coming down a little bit. So this happening. Now, this data is important. Why? Because if you see the data point earlier, we are used to have a huge earning growth in last 2 to 3 years. Now it is slightly coming down, with the earnings slightly coming down, not as far as the earlier earnings. Obviously the earning will not be higher because earlier the base was lower. Okay, if you see the data point of 2019-20, the earning base was lower, that is the percentage was looking much higher. So now since the base has already increased, so you will have a lower earning growth happening. And that is one of the factor, because since we already showed you that the valuation are very steep right now, if the earning growth continues to do not perform as far as the market expectation, this one, So this might get a little bit of factoring out. Okay. So that's what we look out for. So earnings you have to look out for in companies, because the sector which I have told you right now, if you going ahead, you will see a lot of people are still investing in small cap. A lot of people are still investing in thematic funds or in theme based. So that where people have to be little bit of cautious, because earnings, if they do not catch up, then you see a steep correction out here. Um, Whereas large cap looks very attractive at 14% premium, also attractive. Now, again, I'm telling you that if you see the average, now when people talk about average, what the duration you are taking, that is important. If you see the last 5 year average, obviously the average will be higher than 18.5. So uh, if you are taking a data from beyond 2014, obviously the average will be like that. So, but what we have seen that whatever policy reforms and initiatives government has taken are taken from the 2014 onwards, and the results which predominantly start coming up post COVID in 2021, 2022, and that's why you see the data from 2021 onwards, see the rise happening. So the average will actually be a little bit of dilution, which no one will tell you. People will tell you an average of 15 years, but don't take average of 15 years, because uh, 10, 12 years back, India was different altogether. Now India is different. So you have to take average of the 5 years to get what exactly happening. So if you see the average of 5 years, I will say it is not at costly right now. But yes, you have to look very very carefully for the earnings. This data is important, because ultimately the earnings are important as far as the market to perform. This data is important, though it has shown a slightly slowing down, but with this festive time coming up, this we can have a better earnings than last quarter. Okay. So moving on, many stock have delivered returns. So this is we don't have to talk about the returns, because most of you who have invested in stock market or mutual fund might have gained a massive return in the last couple of months, and so this is normal data point which have been fetched out across. See the small cap return. If you see in this is the kind of return that December 2005 to August 2024. So that's the kind of huge return which we have generated over the years. Last 4 years, see 30% annual return. So that's huge. So that's what we are talking about. Like if you are invested heavily into small cap, try booking the profit out there. Okay. If you're investing systematically, let it go. But if you have invested in a small cap, try booking profit there and move on to the large cap base. There are large cap companies which has not increased in the last 4 to 5 years, but fundamentally they are very strong. I'm not going to mention any stock name out here, because I am not allowed to mention stock name as an advisor in open platform by the SEBI. So I will restrict from that, but I will give an overview that uh, large cap you should look out for, and small cap try to book profit as much as you can. Take profit in rising market. I told you, take profit in rising market, switching your portfolio in the rally, quality or momentum, reasonable valuation about expensive valuation, high floating stock market discovery. So concentrated holding. Be ready for the volatility. Volatility क्यों होगा? Because of US. We have seen what happening in US. US being a big influencer of the on the global economy, so any disruption there can impact Indian market. Government geopolitical risk will always be there. There are a lot of things that are happening in the globe. Oil price, although it is coming down, we have to keep a strict eye on that. And earnings. So I have been telling you that earnings, above all these things, the most important factor is earnings. So keep an eye on the quarterly reports that are coming up. Although we try to inform you every month about what's happening in the earnings front. But as of now, as the earnings looking, you have to be booking profit in a where you have already stretched a lot of earning in that thing, and try to park those profit into a large cap segment where earnings has where price has not moved as the company's earnings shows. Okay. So that's all from the equity market. Debt market, we will quickly move on. US CPI declining stage for rate cuts. मैंने आपको पहले ही बोल दिए थे फेड का, US Treasury, global 10-year GSEC yields. If you see the 10-year GSEC yields, you see the India 10-year GSEC is 6.86%, and UK, you have US. See the US 10-year yield is 3.9%. So So that's about 10-year, which is a benchmark of any country's fixed deposits, fixed instrument. That exactly showing up here. Fiscal consolidation. I just quickly move. CPI inflation is coming up, coming down. I told you earlier. Invest all macro, invest in duration. So if you are investing in debt markets, okay, if you are investing in corporate bonds, government bonds, so I will suggest to buy a little bit of medium to long duration paper, because rate cuts will happen, because this data actually tells very clearly that since the inflation is coming down, you have a rate cuts happening very soon in India also. So if that's happening, if you have a long duration paper, you will get a double-digit return in your bond also. Okay, so try investing in a mid to long duration bond paper to get the advantage out of it. Okay, so I already told you. See, this is a debt to GDP ratio out here. Now, this is so if you are investing in fixed deposits kind of thing. So there are paper, there are funds which actually invest in fixed in corporate bonds in all segment. So this is one of the funds. I will not going to mention the company's name, where they are coming up with a paper where you have all the institutional investors. These are all fixed income like NABARD, Small Industries, National Housing Finance, Bajaj, Kotak Mahindra, Axis, Aditya Birla, Tata. These are all corporate bonds, okay? And see the kind of percentage that they're having. So the equal weightage in all companies. So if you're looking to invest in corporate bonds, you look for this particular options out there, AAA Financial Index Service Index Bond Fund, which will be attractive for you. Okay, if you want to know more about it, I can let you know. Just DM me once the session is over. So I just quickly move on. So gold price, we have seen that there's a huge surge of gold inflow coming up, and gold share international reserve was also increased. Falling Fed rate support gold price. American are selling stocks to bet on sports. So Americans spend more money in betting than on sports than investing in stocks. So this data has come up very recently. Though they are getting impatient because they are pairing those 5-10 stocks like those FANG index, which normally have Apple, Microsoft, Facebook, Tesla. So bearing those top 5-7 companies, most of the American stock are on decline. So what they are predominantly doing is they are betting more on sports than on stocks. Foreigners sell Indian stock, buy bonds in August. Now, this data I have already showed you to a couple of people is that, if you're investing in real estate in India, now, if you have bought a home in 50 lakhs in 2010, now it is 2.2 crore. A lot of people will see, wow, we have grown 4 times. But if you actually see the investment return, it is 8.8%. FD is giving 7.5% or 7% as such. There are corporate bonds which have double A rating, which normally gives you 9%. So if you're buying a property in last 13 years, you get 8.8% return. It's better off you buy a fixed deposit or a corporate bonds, which will give you the similar kind of return. And property selling, you know how hassle is. So that's the kind of return of a property which normally happen. And this data is not from my side. This data is from RBI Housing Price Index. Okay, so there maybe some people will say, "Ki my property, my land has gone this high and that high," but this data is what is actually in front of all of us. Okay, so I mean to say that if you are willing to make money, so probably, obviously, not put all your egg in one basket. Equity has to be a one options out there, because I showed you the data point, how the market is improving over the years. Just okay, so there are policy intervention are rising. About 2,000 policy interventions added every year. Improved sanction in 2023, actual capex to peak with a lag. A recession could change the S&P 500 trajectory. Bull market in picture. This is a global market. Let's quickly move on. BSC small cap index, BSC small cap index, and S&P 500 index. So these are all performance. If you see the PSC small cap index versus S&P 600 small cap index, So that's a clear difference you can see. I told you now. So in S&P, so there has been a huge difference. Okay, so that's what top companies are performing and other companies are not performing. So that's what is actually portraying the slides also, as far as if you talk about the Indian market with the other market. So clear divergence between defensive, domestic, and global cycle. So if you see this data point, this is a domestic cycle, cyclical companies. This is a global cyclical companies. This is a defensive cyclical company. This is a Nifty. So that's the performance index from the last 10 years I have shown you, 1 year forward PE basis. Now, this is a data point, BFSI, excluding insurance. See the performances, 1 year forward PE. This is the Nifty. This is the auto and all these things. So you can see the telecos, consumer, cement, capital good, logistics. So this is higher than the average, and these are companies which are on the lower side. Let's just quickly move on. Now, this is what exactly happening. The retail investor, if you see the total investment in June, in billion, out of 406 billion, thematic and sector fund has constituted more than 50%. Okay, so that's a real cause of concern. If you consider large cap, see it is less than 2% nearly large cap investment happening, and most of the money has gone for the thematic and sectoral fund and small caps and mid cap segment. So which I've already told you why the small and mid cap has risen because of this, because retail investors have seen the 30%, 40% return in past, so they keep on investing there. Valuation is steep out there. The earnings of those companies, although there, but it has moved beyond its fair valuations. So that is what happening. So I just request you, if you have too much exposure in thematic and small and mid, keep moving from there into a large cap segment, as far as the fund, as far as the stocks, whatever it can be. Okay, so but just because we have a number of liquidity, you are not feeling the pain. Because we have a lot of liquidity, that's what happening. Even a couple of weeks back, one small this two-wheeler shop, they have two-wheeler showroom, they have come up with an IPO, and it has gone a crazy valuations. Now there are IPOs, a lot of IPOs are coming up. The company which might in the next 5 to 10 years will not any profit, but they're getting huge funds, which is why happening is that a lot of liquidities there in the market. A lot of people are not very conversant with the data which I have showed to you. They do not follow the data. They just follow with the emotion and momentum and not what people and that people are saying. So it's not about what other people are doing. It's your money. So I will recommend you to go into the large cap segment, book your profit, stay out there. Although we are not seeing any visible risk coming out ahead in India as such, but the valuation is steep. I showed you the valuation are really steep. Just because you have a huge liquidity, the money is coming up, it is holding up. But if the earnings which I've told you, it continue in this way, a little lower in next 1 or 2 quarter, you can see a steep downfall from there itself. Majority stock return below 20% annually before. So yield curve this and domestic index performances. So this is the index performance. If you can see, just quickly move sectoral index. So in last 6 months, if you see the auto index has gone high, 11.8%. But what I have told you is that Maruti, which is the 53% market share in India auto, its sales has come down in 1 year. So you have to correlate those informations. Okay, if the sales in the top line is coming down, then don't expect the market. Then the stock can go high up. You have to correlate those things. So this is the data point which you have seen. If you see the bank index, okay, I just want to say a bank index. See, in last 5 years, the bank has given only 13% return. So that's why I'm saying the bank are, if you carefully look for any private banks, see their portfolios. If the stock has not gone high for the last 4 or 5 years, very good attractive proposition to invest there itself. Okay, so see the Nifty Media Index in last 5 years given 1%. So you need to take and check for the company also. These I'm talking for the index specific. I'm not talking for the company. So there can be in an index where IT index, it has given last 3 months 32%. Not necessarily all IT company will go on high. You have to look for the company's micro level also. Okay, so this is a general overview about how the index is performing. Now, this is the global index. Don't have to mention as far as the India is concerned. You see 12.5% another index. You see how the differences out there. Asset class keep rolling out. This is a normal data point. So we are in a close of our sessions. So today we have discussed about the data point, normally the same data flow that we maintain over month on month. So what we are seeing in India is that very positive outlook, but we have to be a little bit concerned about the valuations. If you are investing systematically, keep investing. If you have already make a huge amount of profit, book the profit, move into the much safer instrument like large cap and all stocks, where the valuation is not that pricey. If you take 5 years valuations average and move on with that thing. Okay, so that's all on my side. Thank you very much for attending today's sessions. We see you next month itself. If you have any query, you can drop down my message in my personally. I will get back to you when I get time for that. So thank you very much.